Hello, everyone, and welcome to an episode of the Dairy Signal, where we bring forward-leaning, important and timely topics, hopefully at your fingertips or sometimes just at the click of a button. So regardless how you're taking in today's content, thank you. Thank you for choosing this and trusting this as a wonderful resource. Also, I want to say thank you to our national sponsors and partners who help make this possible, helping not only bring forward the Dairy Signal, so it's an easy and accessible tool to you, but also the PDPW programs you see executed throughout the calendar year. So to see not only those programs, go to pdpw.org, but also check out and see who those sponsors are, because again, true thank you to them for helping make this and so many other things possible. Without further ado, as we go into today's topic, I promise you it's an important one. Sometimes not always the sexiest thing, as Troy and I was talking about after the fact, but oh my gosh, do you ever and always need it? And I'm talking about business succession. When you think about structures, when you think about the legal, it gets heavy. It gets not to be the funnest part of any part of business, but it's so critically important. So as you have questions today, as you're listening, please ask your questions. I'll be sure to bring them forward to Troy, or even after the fact. I promise you we're bringing you a great resource to ask and follow up with as well. So without further ado, I was teasing you into this, but we have with us today Troy Schneider. He's part of the Men's Law Firm Group, a great partner, one of our national sponsors as well. So Troy, let's walk into this. Maybe introduce the folks if they haven't already been acquainted with you, but then let's get to it. Let's cut out the fluff. I know I talked about this earlier, but let's get down to business.
There you go. Yes. So, as Cassie said, I'm Troy Schneider. I'm with the Men's Law Firm, formerly the Tuick, Rieprock, Schneider and Hellbuck Law Firm, which and we have a special emphasis in our law firm on agricultural law, and we've been working with PDPW since the beginning of since the organization started. George Tuick from our firm worked heavily with the organization and right at the groundbreaking aspect of it. So my topic today is to talk about farm business entities, and you hear a lot about well, one farmer's got a S corporation, one's got a C corporation, one's got an LLC, and well, what does that stuff all mean? And I often get questions from farmers. Well, you know, my neighbor, Mr. Jones has this one. Is that better than what I have? It's natural inclination of people saying, well, I know what I have, but they've got something different. So who's got the better one? So I want to start, I guess, a little bit from the beginning, just to kind of run through the different, what we call legal entities. Okay. And it's always important to remember that there's two aspects of business organizations. There's the legal aspect on how they're formed under state law, for example. Then there's the method of how they're taxed for federal income tax purposes. So the different legal entities we have under state law are sole proprietorships, kind of the doing business as, the partnership, which in state law is defined as two or more people that are doing business with each other. That's written in the state statute that way. S corporations, again, and C corporations, and we know what corporations are about. I mean, we see them every day, and the S and C designation refers to more of how they're taxed for federal income tax purposes. Then we have the LLC, which of course is the newest business entity. It's been around for over 25 years now, but that's compared to corporations and partnerships, it's new. And we've got single member LLCs and multi-member LLCs. So the sole proprietorship, that's the easy one. Like I said, that's the doing business as. And if you're a farmer that's just a sole proprietorship, you're filing on your federal tax return on your 1040, you're a Schedule F, where you're reporting your farm income and expense. Then you have a taxable profit or loss, which you then put on the front of your 1040. So that's pretty easy. And that really is the ultimate, what we call pass-through taxation. I mean, the income and expense of your farm passes through down to you personally. Then we have the partnerships. And from a legal perspective, again, state law perspective, the one or more of the owners are fully liable for the debts and liabilities of the farm. Translation, if the Jones family partnership gets sued, they can sue, they can go after the assets held not only by the partnership, but also the individual owners, partners as well. For federal income tax purposes, a partnership files a Form 1065 and reports all of the income and expense, including depreciation and that of the farm resulting in a profit or loss. So then what happens is the partnership files that 1065, and then each of the partners gets a K1 reporting that their portion of the taxable profit and loss. So, for example, if the farm showed a taxable loss of $1,000, and we're Cassie, you and I are 50-50 partners, you would put on your tax return your 1040 a $500 loss from farming, and I would put a $500 loss in farming. Again, it's passed through taxation.
Mm-hmm.
In S corporation, that, like I said, corporations have been for around a long time. Corporations have limited liability. What that means is if the entity itself gets sued, the only assets that are at risk from getting subject to the lawsuit are the ones held by the corporation itself. And what subchapter S corporation means, and it kind of the acronym is small corporation, okay, is that it's passed through taxation, much like a partnership, but with a couple differences, which I'll go through in a little bit. One of the rules in order to be a separate a S corporation is you have to have 50 or fewer shareholders. So that's why they call it S corporation. Then we're familiar with the C corporation, okay? And from a legal status, an S corporation and C corporation are exactly the same thing, okay? And meaning they have liability protection. If the entity gets sued, the only stuff that's at risk are the ones held by the business itself. The difference between the C corporation and S corporation is the entity itself pays the tax. It's not passed through taxation. So, and under current law, that taxable rate is a flat tax rate of 21%. If a corporation, for example, sells, okay, a farmer liquidates sells his farm and it's held by a C corporation, the bad news is the corporation will pay the tax. And now the corporation holds a bunch of cash. In order to get that cash out of the corporation, it has to either declare a dividend or wage. And again, so those proceeds get taxed again. That's a huge negative of a C corporation is the double taxation aspect. Also, much like a C corporation, if you buy stock, corporation stock is like land. It's a non-depreciable asset. So you cannot take that depreciation on your tax return when you buy someone's stock in a corporation. And finally, LLC. So, like I said, when it comes to like partnerships or corporations, the LLC is kind of still the new kid on the block. Okay. From a single person, when you are a single person and own a LLC, you have a lot of choices. You can either be taxed like a sole proprietorship, or you can be elect to be taxed as an S corporation, or you can elect to be taxed as a C corporation. In a multi-person LLC with two or more people who own it, you can elect to be taxed like a partnership, you can elect to be taxed as an S corporation, and you can elect to be taxed as a C corporation. So from a flexibility standpoint, the LLC provides you the utmost flexibility when it comes to taxation and the like. So just running through a little bit of the different entities, of course, people ask, which one is the best? And of course, there's the lawyer answer, it depends. Which people say that's all what lawyers always say is it depends.
Such a PC answer.
Right, exactly. Exactly. So just I want to run through just a little bit of the different comparisons, I guess, of the entities, some of the pros and cons of the ones. And I'm not this I'm only going to name a few, and there's more. But so like I said, with regard to double taxation, that's a negative of the C corporation. If you liquidate the C corporation and sell off, you get taxed at the entity level, plus you also get the taxation at the shareholder level as well too. However, C corporations allow people to deduct fringe benefits much more greatly than either an LLC or an S corporation. What I'm talking about is fringe benefits is like housing allowances, employee meals. Those can be pretty important sometimes for farmers as they provide those things, and oftentimes they're providing them for a shareholder as well. So in a C corporation, also oftentimes you can take what's normally like your house, which you're using after tax dollars to pay for your housing stuff. In a C corporation, if the C corporation is doing it, you're allowed to deduct expenses that would normally not be deductible. So also in a C corporation, one advantage of a C corporation is that for partnerships and S corporations, you generally are stuck with a calendar year end for your tax year. In a C corporation, you can have different tax years. With the C corporation, or I'm sorry, with partnerships and things, if you sell long-term capital gain assets, land, raised cattle that are older than 2 years, you generally get capital gain treatment. Not in a C corporation, the corporation tax rate of 21% would apply. Fortunately, the top tax rate of capital gains is 20%, and the top capital gains rate is 21%. So there's not a huge difference. But with regard to long-term capital gains rates, if your income is low enough, you could sometimes be taxed at a 0% capital gains rate, or 5 or 15.
So Troy, when you're going, and let's say you don't have a structure for your business, but you want to get one. I think the clear choice would be sit down with your attorney and figure that out. But what kind of discussions do you have to help kind of break through what's best for your business? Like, how do you start it to figure it out?
Basically, Cassie, you kind of ask the questions about what this business is going to do and what it's going to own. And that's probably the two biggest drivers about how it would be probably the most advantageous entity choice from an income tax standpoint and from a legal perspective. So,
okay.
And go ahead.
I'll let you finish because I think I have a follow-up question.
Okay. So, like from a legal perspective, people will often ask, well, if LLCs provide you limited liability protection, shouldn't I have like a trucking LLC, a dairy LLC, a cropping LLC? You know what I mean? Shouldn't I just, instead of having my eggs in all one basket, shouldn't I spread them out? I often say you have to analyze the liability risks of what you're doing. Because there are certainly complexities and legal requirements to having a whole bunch of baskets to put your eggs in. Okay. And if you don't keep the baskets all separate, and I always like to pick on the Milwaukee Madison law firms, they'll sue you and go after all of the baskets anyways. So you have to be careful on how complex you want to make your legal structure. Now, if there are higher risk activities, I tend to segregate those into its own LLC. So if you do a lot of custom work, for example, that's something maybe because you're on the road a lot with machinery, not only doing work for you, but for somebody else, that might be a higher liability risk that you might want to segregate that risk into its own LLC, for example.
Sure. Okay. So these are
Right.
long-term, in my mind, these are long-term commitments, which I hope your business, exceeds generations and continues to grow and flourish. All great things. But in the back of my mind, and I don't want to say this like speaks to fear of commitment by any means, but let's say you go down one road and it's time to do a business transition, and the structure that you're in doesn't really seem, how do I say this? Doesn't seem to support what the next generation is going to need. Can you restructure? Like, can you go from a corporation into an LLC or vice versa, depending on what that next generation needs to happen? Is that a possibility?
Um, Again, that lawyer safe answer, Cassie, it depends.
Okay.
In general, I would say that it's much easier. You have more flexibility with entities like partnerships or LLCs that are taxed as partnerships and sole proprietorships than you do with corporations. One of the negatives of the corporations are the way they're taxed under subchapter C or subchapter S. The reorganizations and shifting assets becomes much more difficult without triggering income tax liabilities by doing so.
All right. Okay, I'll let you keep going. This
Okay.
is a great discussion, and I don't want to hold this up. There's a lot to get through yet.
Yep, no problem. So one other thing, one advantage if you look at these choices of entities, C corporation, S corporation, partnership, one thing that is advantageous to the LLCs taxed as partnerships would be the ability to do what we call special allocation. What I'm referring to is that, let's say, Cassie, you and I agree, we might own our partnership 50-50, but you're doing all the work. And you say, hey, this isn't quite fair. I should be allocated more of the profits from the business than just, instead of it being solely based upon ownership. In an LLC partnership taxation, that's allowed. In an S corporation or C corporation, that is not allowed. The profits have to be distributed according to the ownership. Some other things that are kind of different between the different entities are that when you sell stock, for example, all of the stock would receive capital gain treatment, which if you're going to pay income taxes, there's two types of tax. There's capital gains tax and ordinary income tax. Mm-hmm. Generally, the capital gains rates taxes are more favorable than the ordinary income tax rates. So if you're selling stock in an S corporation or C corporation, you receive capital gain treatment on that stock. Versus if you sell an LLC interest in a partnership LLC, you do not receive capital gain. You only receive capital gain on the assets that you're purchasing out from that entity. I know that's kind of a very confusing aspect, but it's almost like the LLC partnership has a mixed bag of assets. For example, feed, raise cows, young stock, land. Depending upon when you buy an LLC interest from somebody, what the IRS says is, well, you're buying a percentage interest in the feed, you're buying a percentage interest in the young stock, you're buying a percentage interest in the adult cattle, and a percentage interest in the land. For example, the feed and the young stock would be ordinary income versus the the land and the raised adult cattle would be capital gain income. So you have to take a proportion of all the different things you're purchasing when you're buying an LLC asset or interest. Excuse me. I know that's a very confusing concept for many people to wrap their head around. So,
can you say that one more time then? Just like the general statement that we started off with that example. Just let my brain absorb it one more time.
Sure. So like if you were buying out my LLC interest from me, okay, mm-hmm. and you're going to pay me $500,000 for that LLC interest, and let's say the LLC owns feed, young stock, adult cattle, and land. The feed and young stock are ordinary income assets. The land and adult cattle are capital gain assets. So I will pay some ordinary income on my 500,000 or the portion of the 500,000 of the young stock and feed. Let's say the of that 500,000, 125,000 of its cattle, 125,000 of its young stock. I'll pay ordinary income on that 250,000. The other 250,000, which is made up of adult cattle and land, which are capital gain assets, I'll pay capital gains tax on that 250,000. If that example helps. So
I think so. Thank you.
One other thing that is important is that is fairly recent is this Section 199A deduction, and that's the domestic production credit deduction. If you have the C corporations are not allowed to take that deduction. Well, I should back up for a second. So, for example, your supply co-op or your milk cooperative can pass through a deduction onto its patrons using the Section 199A tax deduction. You can only take that deduction if you are a pass-through taxation entity for federal income tax purposes. And again, that pass-through taxation entity is a S corporation, a partnership, or a sole proprietorship. C corporations, like I said, are not pass-through taxation because they pay the tax at the entity level. So hopefully, with that little dialogue, I guess I can hopefully you're kind of understanding that it depends answer really is true, because depending upon what the entity is going to own and what it's going to do really depends upon what the appropriate choice of entity would be. But by and large, when you're in a farm transfer, the entity of choice these days is still the LLC, because the LLC does have the greatest flexibility, because you can elect in and out of, not always easily, but you can elect how you want to be taxed for federal income tax purposes. So just kind of walk through some of the LLC tax rules. An LLC is taxed as a partnership. That's the default rule, unless it elects to be taxed as an S corporation or C corporation. When an LLC elects to be filed as a partnership, it has its own methods of depreciation and its own basis in its assets. And all the income and expense flows out to the members in the proportion to their percentage interests, unless they want to specially allocate the profits and losses, kind of like the example I gave to you earlier, Cassie, about you and I owning our partnership together, and you're doing more of the work, so you should be entitled to more of the profit. So, no tax when you put assets into an LLC. If you and I were going to form an LLC together, Cassie, if you put in cash and I put in cows, for example, both of us don't recognize tax when we put it into the LLC. However, if I put in cows and I have no tax basis, meaning I didn't buy those cows, and yet I'm with those cows, you're also putting in $100,000 of debt. Your share of liabilities being put into the LLC is taxable to you. If that's kind of a strange concept for people to understand, that if you're also contributing, if along with assets, that you're also contributing debt to the LLC, that could be a taxable event to you again, because relief of debt is a taxable event. So by putting into an LLC where you were initially responsible for 100% of the debt, but now you're putting into an LLC and are going to be technically only responsible for the 50% of the debt, the IRS says, ha ha ha, okay, I think you should be taxed now, because it's almost like you're getting rid of a liability which is really a taxable event.
Okay.
So
So then you have a bullet on there about a gift of an
yes,
LLC interest. Can we dive into that a little bit? So I think if I'm understanding this correctly, this could be a way for some folks to transition in or out of a
Mhm.
certain business, or one way or one mode to do so. Can we talk through the gift of an LLC?
Yes. I mean, most farm transitions, as we know, people can't get into a farm and pay full fair market value for the assets. It just doesn't work, you know. So generally, parents have to end up having to gift farm assets to the second generation to get them involved in the farm. So if you're gifting a LLC interest, but your basis, meaning if the LLC, your portion of the LLC is made up of cattle, land, etc., that you paid some amount for, but you took tax depreciation. So, like for example, tractors are probably a good example.
Sure. Yep.
You bought a tractor for $100,000 and you took out $100,000 loan against it when you bought it.
Mm-hmm.
But for income tax purposes, you started depreciating that tractor down. Okay. And from an income tax standpoint, your basis, meaning what you paid for that tractor, less depreciation, is down to zero. Okay. But from a fair market value standpoint, that tractor maybe is still worth $50,000. And let's say you have $40,000 of debt on that tractor yet remaining.
Mm-hmm.
If you gift that tractor to your son or daughter, and you have just created a taxable event for yourself because it's like you sold it to your son or daughter for $40,000, the amount of the debt.
Mm-hmm.
And you have no offsetting remaining tax basis left on the tractor because you've taken all the depreciation out of that tractor already. So think of when you form an LLC and you gift the LLC interest, it's like this mixed bag of all these different things you've contributed to the LLC and gifted at that same time. It's again a very difficult concept sometimes to wrap your head around. So
there's no easy button, is what we're getting at here.
right, yep, exactly. So in most cases, when we do a farm transition, the parents will form an LLC or other legal entity to operate the farm business and owning the farm personal property. And a lot of times they'll lease the farm real estate to the LLC. It's a great way. I mean, farm transition planning has kind of been the same for generations. Parents tend to get rid of the cows and machinery equipment first.
Mm-hmm.
Next, they transfer the building site. And the last thing they hold on to and transfer last is the land. The LLC is just a different mechanism of doing that farm transfer, in a different format. And there are benefits of why to do it in the LLC format rather than the format that I just explained, which I'll call the more quote unquote old-fashioned way of doing things. So for example, the LLC can provide you, like I stated, liability protection. If the cattle and the machine equipment are the things that are going to cause the lawsuit. So you've segregated the real estate, which doesn't really cause lawsuits, from the higher risk activities of the LLC. Again, percentage of membership interest or LLC units can be transferred rather than taking a piecemeal approach to gifting of certain assets. And there are really, and I'll get to this in a couple slides down, but that is a little better approach because you don't want to, after you've gifted something, for it to walk off the farm on you, literally. So you've gifted cattle to, and it's very common where parents gift cattle to their son or daughter the longer they've been working on the farm. What happens though if they get mad someday and say, well, I'm taking my cattle, I'm backing up the trailer and picking up my cattle and taking them down to my in-laws' place because I'm mad at you, mom and dad. If they hold an LLC interest, that's not quite as easy. You've made something that's that's more liquid into more of an illiquid type of asset, which can provide better protection for the family as they do their succession planning. And kind of the next bullet point, often a simple LLC agreement is adequate, but a fully developed LLC, when we talk to all the different aspects of what could happen, is a much better approach.
Kind of under the mentality that your LLC isn't an insurance policy. It helps protect. It's a structure, but it also helps, obviously, to the name, helps minimize the liability that could come back to the business. But obviously, insurance is still needed or strongly encouraged for your operation.
Correct. Yes. Yep. It's no substitute. I always call it a speed bump, but you need to have insurance as the full backup plan. So I'm just going to skip a slide here. So when you put together a LLC an LLC, one of the things you put together is what's called the operating agreement. And what an operating agreement, it's almost like the bylaws when you have bylaws of a corporation. The LLC operating agreement is the thing that talks about what are the rules of our LLC. In an LLC operating agreement, you can have different membership types of classes of membership interests. For example, you can have common units, preferred units, or incentive units or profits interest. And I'm going to walk through those a little bit. So the common units, so you could say in the common units, you could have voting units and non-voting units, which is easy to understand. You get some of the equity share, but you don't get necessarily any voting control over the entity. In common units, essentially, as the farm appreciates in value, okay, you get your percentage of growth, okay, by owning your common units. Versus preferred units, okay, it's with a fixed value. So if you decide to have, let's say the farm is worth $1 million, okay, and you say, well, I'm going to have $1 million of preferred units. So if the farm grows to 1.5 million, it doesn't matter. My preferred units are fixed at the $1 million. The reverse could also be true, is that if the farm drops in value, my preferred units are at that preferred value, and the common unit holders are the ones that are going to take it in the shorts. If the farm would drop in value in that case. Incentive units, that's a powerful tool that's available to LLCs. What you can do is, rather than making a gift where you have to put that in your gift tax return, for example, you can say, well, as long as you stay working here, the profits, I'll give you 10% of the profits, for example, meaning that the growth in the farm can be given to you by granting you a profits interest into the farm. Also, management of the LLC, basically the decision makers of the LLC, you have a lot of flexibility in how you want to put your LLC agreement together. Some LLCs have what they call managers, which just talks about, okay, here are the people who make the calls. They're called managers, and we have to agree either by, if you have two or more, either by majority vote, sometimes you have super majority vote on decisions. Some LLCs, actually, we put together, we have a board of directors type of structure. This is probably more common when you're involving investor owners into your farm, for example. There might be some decisions made at the member level. There might be some decisions made at the manager or board of director level, and might be some decisions made at the daily manager type of level. Again, you can structure that LLC any way you like. In a LLC operating agreement for succession planning, we often talk about what are the requirements for service. For example, most family LLCs only want the LLC to be owned by people that are contributing labor management to the farm, versus the more investor type of format where that's not the case. The only exception, of course, is the parents, because they get special rules. So, and again, in the operating agreement would be the place to spell out some of the different things that are decided by members or managers. And kind of what that slide kind of shows is just a different laundry list of the different things you might want to provide. One of the advantages, like I said, of having putting your farm assets into an LLC, then transferring LLC member units or LLC interests, rather than making direct gifts of farm assets like cows and machinery and things, is the ability to put restrictions on what you can do with it once you got it, type thing. So, for example, in permitted transfers, oftentimes we say we give a list of things. Okay, it's okay if we transfer assets to our spouse, to our kids, as long as they're providing labor and management to the LLC. In multi-sibling LLCs, the agreement should allow each family to maintain its percentage of ownership within the family's group. So, for example, I always like telling war stories. Okay, there was a farm that brothers farmed together, and when they first started farming, their children were very, very young. And the operating agreement provided that if one brother passed away, he would buy out the surviving brother's spouse, which would seem very appropriate at that time, using life insurance proceeds to buy out your deceased brother. Fast forward, though, 25 years later, and the agreement wasn't updated. Okay. Each of the brothers have kids working on the farm. And they provided, quite a few years of labor and management to the farm. Brother passes away. They still got the old operating agreement. Brother buys out the half the farm using life insurance proceeds from the deceased brother's widow. But now the kids that are the sons and daughters of the deceased brother will never have an opportunity to own the farm ever again. So that's why it's really, really important as you develop an operating agreement to continually update it based upon the circumstances of the farm.
And what would be like a suggested check-in? Is it a yearly? Is it like every 5 years? Like, everybody's going to have their own benchmark, but in a perfect world scenario, how often do you reflect back on this and make sure it's up to par with the current operating of the business?
I think, every farm should have sort of an annual meeting or annual check-in meeting. And, the natural idea is, normally that happens at the end of the year in the winter months, at that point you should, as part of, just like you're reviewing, well, what purchases, what prepays do we have to make and things to lower our taxable income, or do we have to not do that this year? The same check-in should be is our agreement up to date? If something bad happened, is this how we would like to it to turn out? I always joke the time to write your prenuptial agreement with your spouse is when you're getting along, not when you're not getting along. That's kind of that ship has sailed at that point. So same thing with an operating agreement. You can create objective answers to your agreement when you don't know what circumstance you're in at that time. So that's why it's really critically important to do the things at the time before something happens.
Mm-hmm. All right.
So often in LLC operating agreements, there's certain triggering events written in there, like, okay, if someone dies, if they are either quit or retire, or if they want to transfer their or just withdraw, what happens to their LLC units at that point? It's important then to spell out, A, so the farm can buy back those units at a price they can afford, and B, so the person who does want to get out has a reasonable market for their LLC units, so they just don't hang around. You know what I mean? Because if it's not worth anything, I might as well just continue owning them, which doesn't create a fair result either. So, also with regard to, and then the ordering of the options, for example. Again, going back to my example of the deceased brother that passed away with kids that are involved in the farm, the kids who were his kids should have had the opportunity to buy those LLC units from the estate and come to an agreement because they were involved in the farm. So, again, key provisions of operating agreements, you should talk about it with regard to how the interest in the farm, how it will be valued. Typically, the old standard in all the operating agreements is, well, we take what everything is worth and we subtract off the debt, divide it by, or times the percentage of ownership I own in the LLC. That's what my LLC interests are worth. In farming, as you know, that sometimes that's not the best approach, especially because you're dealing with a business that has its high asset value, low income. So having an agreed upon valuation that makes sense for that particular farm is really, really important. But again, I can't stress how it's oftentimes different strokes for different folks. Farms are not all in the same financial position. So you have to tailor your valuation formulas to what's appropriate for that particular farm. Then once you decide, oftentimes in the LLC operating agreement, how the value is going to be determined, now it's how you're going to pay for it. If there's life insurance, life insurance proceeds should be applied towards that purchase usually. And then if there's inadequate life insurance proceeds in the event of a death, or if somebody wants to withdraw, perhaps they have to quote unquote play the banker for a while, because if the farm just doesn't have the liquidity or the borrowing ability to go to the bank to make that buyout happen, that's really kind of, you're stuck with that alternative approach. So oftentimes in the LLC operating agreement, there's things about, well, if we want to make sure your LLC interests don't leak out to non-family members, for example. There's provisions oftentimes in operating agreements so that you don't get stuck in a business entity with somebody you're not comfortable being in business with. So there's often things like tag along and drag along rights and that kind of thing. Also, you have to decide things as, for example, unanimous vote, supermajority vote, and that kind of thing. With regard to sibling LLCs, for example, I really like the approach where if you have 3 or more siblings in an LLC that own the LLC, somebody should be given the right to, I call them being voted off the island. Meaning if you have a sibling that's being a real pain, you should build into the operating agreement where they can be removed as a member pretty easily by the other 2 or more that still want to basically be in business with each other. So in a typical, that chart this drawing might seem a little crazy, but it gets crazier. In a typical LLC transfer, what you really most of the time see is parents contributing feed inventories, selling or gifting livestock and putting machinery into the LLC, and sometimes the building site, okay? And a lot of times, like I stated, they lease the land to, the parents usually lease the land to the LLC. Then the parents and kids can sit down and talk about, okay, about how we want the capital owned, the growth owned, and the profit split. And the nice part about an LLC is about the amount of flexibility that those percentages can be different. For example, parents might still own 75% of the LLC, but they say, you know what? If the LLC grows in value, I want to make sure that the growth is split, and maybe they're bringing a son and daughter into the LLC. I want to split so they get all of the growth on a 50-50 basis. Also, I want to make sure that their profits, that they get the profits on a 50-50 basis, and therefore our equity is kind of frozen on the equity we've created, and we're comfortable with the next generation sharing in the equity growth. So one issue you sometimes run around is, for the reasons, kind of like I stated earlier, corporations, because of not being able to depreciate stock, and because of not getting some of the favorable tax rates, but they do get some of the fringe benefits. So there's a pro and a con. Okay, sometimes a lot of times, old farms that were done in the 70s, for example, have C corporations. It was very, very typical. Sometimes it makes sense to start to liquidate or cull out assets out of the C corporation, especially a C corporation that wants to liquidate. So sometimes we create sales to try to, what we call, cull assets out of the old corporation to get those assets moved into a LLC. Also, a lot of times if we have an old C corporation, we have a new LLC make the new purchases or build the new building for the farm using the LLC in conjunction with the old corporation to operate the farm. So sometimes farms, as you know, can get really, really big. Under current laws, the current estate tax exemption, as we know, is pretty generous at a $15 million exemption for a single person and $30 million exemption for married couples. But if you have a large farm, then you end up having to do some very complex type of succession planning using entities, which could be, and this is going to be a little bit beyond the scope of today's seminar or podcast, but you could have entities that are owning life insurance, land, so you can do discounted gifting, LLC interests held by special trusts, so you can avoid or minimize your estate tax exposure. And like when I said that it gets crazier, you could end up something that looks more something like this. So,
and for those that are just listening, you're not, oh my God, your brain would just be going, like picture a bag of cats just scattering. That's what this meant.
Correct. Yeah. So, like I said, it can get crazy and it can get complex, but hopefully I was able to just kind of explain some of the basic concepts. So as you talk to your accountant or your attorney or and such, they toss out these things that hopefully I provided some context of where they're coming from.
So what I'm getting out of this, Troy, is a lot in a good way, is definitely play the what if game. When we sit down with our attorney, kind of go through some of the what ifs, talk about your vision and kind of fill in. It's okay to go with a blank grid and start to fill in kind of what your goals and objectives is, short term versus long term. And hopefully you have the right person alongside you to help steer or guide you in the direction that's going to be best for your business. Or if you're in something, like if you're already in a good structure, keep it updated. Those are my two key aha elements. As we go into today, next week, just go forward within our own operations. What would be your key aha or takeaway from today's discussion? What do you want them to walk with?
Um, one, maybe just a little twist on what you said, but recognizing that not all two situations are alike. So just because your neighbor has XYZ doesn't mean that you should have XYZ. Maybe you need ABC instead.
Mhm.
But the second one is I share your sentiment 100%. It's really important to make sure your documents don't get stale because quite frankly, sometimes stale documents are almost worse than having no documents if they don't say the right things. So it's really important, like you said, Cassie, to make sure things are updated frequently and looked at.
Absolutely. Well, Troy, thank you. It's always a pleasure and mind-blowing experience having you here on the Dairy Signal or just in general talking with you. So thank you for sharing your time here today. And also thank you to Men's Law and your team for being a long-standing partner with PDPW. It's something we greatly value and appreciate. There's a lot of questions we've thrown your way throughout the years that we have learned a lot. So thank you. Thank you for all of it. As we go in today and wrap up today's element of the Dairy Signal, thank you for tuning in. And we'll see you soon. And back again at the next Dairy Signal. We'll see you next week. In the meantime, take care, everyone, and be well.